While the world watches meme stocks and headlines, a silent switch was pulled in Tokyo. Not a crash, not a headline, just a number. A bond yield crossing a line it hasn't touched in decades, and with it, the invisible engine that's been funding everything, stocks, real estate, corporate debt, your business loans, just reversed direction. Japan isn't raising rates because the economy is strong. They're raising them because they have no choice. And when the world's largest creditor stops exporting money and starts pulling it back home, the question isn't if the dominoes fall, the question is which one tips first. Welcome to John AG. Now, before we dive into what's actually happening behind closed doors in Tokyo and why it matters to your portfolio, your business, or your financial future, let me ask you something the way I'd ask my father. If you've been watching economic channels for years, seen the cycles come and go, and you know the difference between noise and signal, would you do me the courtesy of subscribing? It's just one click, but it tells me you're here for the real analysis, not the theater. And drop a quick comment, just your city or country. I'm curious, where in the world are serious people still paying attention? Are you watching from New York, London, Mumbai, Toronto? Let me know below. Now, let's talk about what just happened in Japan and why almost nobody is connecting the dots. A number appeared on trading screens in Tokyo. To most people, it meant nothing, just another bond yield, just another data point in the endless stream of financial information that flows through global markets every single day. But to those who understand how the global financial system actually works, that number was a warning signal. The Japanese 10-year government bond yield crossed 2%. The 30-year bond pushed toward 4%. The 40-year bond climbed above 4%. These are not dramatic numbers. An American investor looks at these yields and sees nothing unusual. The United States has seen much higher rates. Europe has seen higher rates. But Japan is not like other countries. Japan has spent 40 years teaching the world that interest rates could stay at zero forever. For 4 decades, Japanese bonds paid almost nothing. Sometimes they paid less than nothing. Investors actually paid the Japanese government for the privilege of lending them money. This was not a temporary situation. This was the foundation. This was the structure upon which trillions of dollars in global investment strategies were built. And now, that foundation is cracking. Here is what most analysts miss when they look at Japan. They see an economy. They see a central bank making policy decisions. They see numbers on a screen, but they do not see the machine. Japan is not just another economy in the global system. Japan is the creditor. Japan is the vault. Japan is the country that has been lending money to the rest of the world for decades while earning almost nothing at home. When a Japanese pension fund manager sits in Tokyo looking at domestic bond yields of 0%, he faces a simple calculation. He can keep money in Japan and earn nothing, or he can send that money abroad. He can buy American Treasury bonds. He can buy European corporate debt. He can buy real estate in New York or London. He can fund businesses in emerging markets. For 40 years, the answer was obvious. Send the money out, find yield somewhere else, anywhere else. This is how Japan became the invisible sponsor of global growth. Japanese insurance companies funded American mortgages. Japanese banks bought European bonds. Japanese pension funds poured money into foreign stock markets. Trillions of dollars flowed out of Japan and into the rest of the world. This flow was not charity. It was mathematics. It was the rational response to a simple problem. Zero yields at home, positive yields abroad. But mathematics works both ways. When Japanese bond yields rise, when domestic bonds start paying 2%, 3%, 4%, the equation changes. The money does not need to leave anymore. The money can stay home. And when you manage billions of dollars and your job is to find safe returns, and suddenly your own government is offering real yields for the first time in 40 years, you bring the money back. This is not a prediction. This is not speculation. This is how capital allocation works. Money flows toward higher returns. When returns rise at home, money comes home. Now, here is where the story gets dangerous. The world has been running on Japanese liquidity for so long that most people forgot it was there. It became invisible. It became part of the background. But just because something is invisible does not mean it is unimportant. Think of global markets as a giant pool. For decades, Japan was pouring water into that pool. Not loudly, not dramatically, just consistently. Day after day, year after year. Trillions of dollars flowing out of Japan and into foreign assets. The pool stayed full. Asset prices stayed high. Credit stayed cheap. Businesses could borrow easily. Governments could fund deficits without trouble. But when the hose gets turned off, when Japan stops pouring water into the pool and starts drawing water back out, the level drops. At first, nobody notices. The pool is enormous. The change is gradual. But the shallow end starts to show cracks. Then the deep end starts to reveal what was hidden underneath. And eventually, people realize the pool is not just low. It is emptying. This is the mechanism. This is what is happening right now. While most of the world watches other headlines and chases other trends, Japan's yields are rising, Japan's capital is coming home, and the global liquidity pool that funded everything, the stock rallies, the real estate booms, the corporate expansion, the government spending, is starting to drain. The question is not whether this matters. The question is, what breaks first when the money stops flowing? In 1985, 5 men sat in a hotel room at the Plaza in New York City. They were not elected by anyone. They did not appear on television. Most people in the world had no idea this meeting was happening. But in that room, those 5 men signed an agreement that would reshape the global economy for the next 40 years. They decided the Japanese yen was too weak. They decided Japanese exports were too competitive. They decided Japan needed to change. And with a single agreement, they forced Japan's currency to double in value almost overnight. The Plaza Accord was supposed to fix trade imbalances. It was supposed to make American manufacturers more competitive. It was supposed to solve a short-term problem. Instead, it created a trap that Japan would never escape. When a country's currency doubles in value that quickly, everything breaks. Japanese exporters could not compete anymore. Factories closed. Workers lost jobs. The economy that had been roaring forward suddenly stalled. And the Japanese government faced a terrible choice. They could let the economy collapse, or they could flood the system with cheap money. They chose cheap money, and they never stopped choosing it. This is the origin of Japan's zero-rate world. This is where the machine was built. Not because of economic theory, not because of careful planning, but because a currency shock in 1985 forced Japan to become the world's permanent lender just to survive. For 3 decades, the Bank of Japan printed money, bought bonds, and kept interest rates at zero. They did quantitative easing before the term was even invented. They experimented with negative rates before Europe tried it. They turned their central bank into the largest owner of Japanese government bonds, Japanese stocks, and Japanese real estate investment trusts. The Bank of Japan's balance sheet is not just large, it is monstrous. It holds assets worth more than the entire annual economic output of Japan. No other major central bank in history has ever operated at this scale for this long. But here is what makes Japan different from every other country that prints money and keeps rates low. Japan has debt that no other nation could survive. Right now, Japan's government debt sits above 260% of GDP. To put that in perspective, if Japan's entire economy worked for free for 2.5 years, producing everything it produces, earning everything it earns, it still would not pay off the national debt. The United States has high debt. Europe has high debt. But nobody's even close to Japan. And when you carry that much debt, you cannot afford normal interest rates. Every single percentage point increase in rates means tens of billions of dollars in additional debt payments, money that has to come from somewhere, money that crowds out everything else the government wants to do. This is the trap. Japan cannot raise rates without destroying its own budget, but it cannot keep rates at zero forever without destroying its currency and its credibility. So they built a machine to manage this impossible situation. A machine made of institutions, policies, and capital flows that kept the whole system balanced on a razor's edge. Japanese pension funds were told to find returns abroad. The government pension investment fund, the largest pension fund in the world, was pushed to buy foreign stocks and foreign bonds. Japanese insurance companies, which managed the retirement savings of millions of Japanese citizens, were encouraged to invest overseas. These are not small players. The government pension investment fund alone manages roughly $1.7 trillion. Japanese insurance companies manage trillions more. Japanese banks hold massive positions in foreign assets. All of this money left Japan because Japan could not offer returns at home. The zero-rate policy was not just about stimulating the domestic economy. It was about forcing Japanese capital to become the world's capital. It was about turning Japan into the funding source for everyone else's growth. And it worked. For decades, it worked. Japanese money funded American treasury auctions. Japanese money bought European corporate bonds. Japanese money poured into emerging markets. Japanese money kept credit cheap and asset prices high across the entire developed world. But this machine has a fatal flaw. It only works when Japanese yields stay at zero. The moment Japanese bonds start paying real returns, the moment domestic investments become attractive again, the entire flow reverses. And reversal is not a gentle process. When trillions of dollars start moving in the opposite direction, it does not happen quietly. It does not happen slowly. Capital flows are like rivers. When the river changes course, everything in its path gets swept away. Japan is not choosing to raise rates because the economy is strong. Japan is being forced to raise rates because inflation has appeared, the yen has weakened, and holding rates at zero is no longer politically or economically sustainable. The machine that was built to manage an impossible situation is now breaking down. And when this machine breaks, it does not just affect Japan. It affects every market that has been drinking from the river of Japanese liquidity for the past 40 years. The architecture is crumbling, and the world has not yet realized it is standing inside the building. The selling starts on a Tuesday morning, not in Tokyo, not in New York, in London. A European insurance company receives instructions from its risk committee. Their Japanese bond holdings are finally yielding something meaningful, 2.5% on 10-year JGBs. Not exciting by historical standards, but after 20 years of zero, it looks like a gift. The order goes out. Sell $500 million in U.S. corporate bonds. Repatriate the capital. Buy Japanese government debt. One insurance company, one decision. $500 million. It barely registers in the market. Corporate bond prices dip slightly. A few traders notice. Most ignore it. Just another day. Just another flow. But that insurance company is not alone. In Tokyo, a pension fund manager runs the same calculation. Why hold American Treasury bonds yielding 3.5% when Japanese bonds now yield 3% with no currency risk? Another order goes out. Sell $1 billion in foreign government debt. Bring it home. In Osaka, a regional bank makes the same decision. In Nagoya, another pension fund follows, each one acting independently, each one making a rational choice based on the same new reality. Japanese yields are rising. The math has changed. Capital is coming home. This is not conspiracy. This is not coordination. This is something far more dangerous. This is consensus. When trillions of dollars in institutional capital reach the same conclusion at the same time, markets do not adjust smoothly. They break. Here is what most people do not understand about global liquidity. For the past 40 years, Japanese institutions were not just investors in foreign markets. They were the foundation. They were the buyers of last resort. When the U.S. Treasury needed to auction bonds, Japanese institutions showed up. When European corporations issued debt, Japanese insurance companies bought it. When emerging markets needed funding, Japanese banks provided it. This was not charity. This was yield-seeking behavior. But it created a dependency that nobody wanted to acknowledge. Global markets became structurally reliant on Japanese capital inflows, not occasionally, not sometimes, every single day, every single month, for decades. The numbers are staggering. Japan holds over $1 trillion in U.S. Treasury securities alone. Japanese institutions own hundreds of billions in European bonds. Japanese pension funds hold massive positions in global equity markets. Japanese banks have lent trillions to foreign borrowers. All of this capital was deployed abroad for one reason. There was no return at home. But when the return appears at home, when Japanese bonds start paying real yields, the $1 trillion does not stay put. It moves. And when $1 trillion moves, it does not move politely. Think about what happens in practical terms. A Japanese pension fund decides to sell $50 billion in U.S. corporate bonds. Who buys them? Another pension fund? Maybe. But if that pension fund is also Japanese and they are also repatriating capital, who is left? The buyers disappear. The natural demand that kept bond prices stable and credit spreads tight evaporates. Prices fall, yields rise, credit becomes more expensive. Companies that were planning to refinance debt at 4% suddenly face 6%. Companies that could afford their debt service at low rates suddenly cannot. This is not theory. This is mechanical. This is what forced deleveraging looks like. But it gets worse. Because Japanese capital did not just buy bonds, it funded the carry trade. The most important, least understood trade in modern finance. Here's how the carry trade worked. Borrow yen at 0%, convert it to dollars, buy USAW stocks or real estate or anything that yields more than zero. Pocket the difference. For years, this trade was free money. Hedge funds did it, investment banks did it, corporations did it, even individual traders did it. The yen carry trade became so large, so embedded in global markets, that estimates put the total size in the trillions of dollars. Nobody knows the exact number because much of it happens off balance sheet, through derivatives, through complex structures that hide the true exposure. But here is what everyone does know. When Japanese yields rise, when borrowing yen is no longer free, the carry trade reverses. And when a multi-trillion-dollar trade reverses, it does not reverse slowly. Traders who borrowed yen to buy assets now need to sell those assets to pay back the yen. Hedge funds face margin calls. Algorithmic trading systems hit stop-loss triggers. Risk managers demand deleveraging. The selling feeds on itself. Asset prices fall, which triggers more margin calls, which forces more selling, which drives prices lower. This is the cascade. This is what happens when the liquidity that held everything together starts draining away. Look at the U.S. Treasury market. Japan is the second largest foreign holder of American government debt. When Japan stops buying, when Japan starts selling, who fills that gap? The Federal Reserve is not printing money anymore. China is selling treasuries, not buying them. European institutions are dealing with their own problems. The natural buyer base is shrinking while the supply of debt keeps growing. Governments still need to borrow. Corporations still need to refinance. But the pool of willing lenders is getting smaller. This is how interest rates spiral higher, even when central banks do not want them to. This is how credit markets freeze, even when the economy seems fine. The cascade has already begun. Credit spreads in corporate debt markets are widening. Liquidity in certain bond markets is deteriorating. Volatility is rising in currency markets. These are not random events. These are symptoms of the same disease. Japanese capital is reversing course, and every market that depended on that capital is starting to feel the strain. The question is not whether this will cause problems. The question is which market breaks first, and how far the contagion spreads before someone finds a way to stop it. The Bank of Japan governor sits in a meeting room in Tokyo. In front of him are two choices. Both are bad. One is catastrophic. He can keep yields low by printing more money and buying more bonds. But the yen is already weak. Inflation is already rising. Japanese citizens are already angry about the cost of imported food and energy. This path leads to currency collapse and political crisis. Or he can let yields rise, let the market find its natural level. But Japan's government debt is so massive that every percentage point increase in rates costs the Treasury tens of billions of dollars. Money that does not exist. Money that would require cutting pensions, cutting health care, cutting every promise the government has made. There is no third option. There is no clever policy solution. There is no way out that does not involve pain. This is the reality that central bankers face when debt grows too large and promises become impossible to keep. And this is why what happens in Japan matters to someone running a business in Germany, or managing money in Canada, or building a startup in India. Because when a central bank loses control, when a major economy enters a debt spiral, the effects do not stay contained. For business leaders and entrepreneurs, the immediate question is simple. What does this mean for access to capital? The era of cheap money is ending. Not because central banks want it to end, but because the structural conditions that made cheap money possible are breaking down. Companies that plan to refinance debt at low rates will face higher costs. Businesses that relied on easy credit to fund expansion will find lenders more cautious. Startups that expected venture capital to keep flowing will discover that investors are suddenly risk-averse. This is not speculation. This is already happening. Corporate treasury teams at major companies are quietly extending debt maturities. They are locking in rates now, even if those rates seem high, because they understand what is coming. They see the same data. They run the same models. And those models show that credit conditions are tightening. For asset managers and investment professionals, the challenge is different, but equally urgent. The traditional 60-40 portfolio, 60% stocks, 40% bonds, was built for a world where bonds provided safety and stable returns. But that world assumed central banks could always step in to support markets. It assumed liquidity would always be available. What happens when the largest source of global liquidity turns off? What happens when Japanese institutions stop buying and start selling? The answer is price discovery, real price discovery, the kind that reveals which assets were actually valuable and which were just riding the wave of easy money. Some markets will adjust smoothly, others will not. The difference will be visibility. Markets with clear fundamentals, transparent pricing, and genuine demand will find buyers even in difficult conditions. Markets that were built on leverage, complexity, and the assumption that liquidity never ends, those markets will face severe stress. The real estate sector is particularly vulnerable. Commercial real estate in major cities has been supported by foreign capital inflows for years. Japanese institutions have been significant buyers of office buildings, hotels, and retail properties in New York, London, Sydney, and other gateway cities. When that capital reverses, property values do not just decline gradually, they gap down. Because real estate is illiquid, because sellers cannot find buyers at any reasonable price, because the bid simply disappears. This creates a cascading effect. Falling property values mean failing loans. Failing loans mean bank losses. Bank losses mean tighter credit. Tighter credit means more pressure on property values. For entrepreneurs and business builders, there's a more fundamental question. How does one build in an environment where the tailwinds have turned into headwinds? The past 15 years rewarded growth at any cost. Investors threw money at companies that were losing money but growing fast. Valuations reached absurd levels based on distant future profits. Risk was ignored in the chase for returns. That model is dying, not because it was never valid, but because it only works when capital is abundant and cheap. In a world where Japanese liquidity is reversing, where credit is tightening, where risk is being repriced, survival becomes more important than growth. Profitability becomes more important than market share. Cash flow becomes more important than vision. This is not pessimism. This is realism. The companies that will thrive in the next 5 years are not the ones with the best pitch decks or the most exciting technology. They are the ones with strong balance sheets, real revenue, genuine profitability, and the ability to operate without constant capital infusions. Here is the hardest truth for decision makers to accept. This is not a temporary disruption. This is not a dip to buy. This is a structural shift in how global capital flows work. Japan cannot go back to zero rates without destroying its currency, but it cannot sustain higher rates without destroying its fiscal position. So it will do what all trapped governments do. It will stumble between these two impossibilities, creating volatility, uncertainty, and periodic crises. And while Japan stumbles, the rest of the world will feel every tremor. The businesses that survive will be the ones that prepare now, not by panicking, not by making drastic changes based on fear, but by building resilience, by strengthening balance sheets, by reducing dependency on external financing, by assuming that capital will be more expensive and less available than it has been for the past decade. The pool is draining. The smart players are not denying it. They are not hoping it will refill. They are positioning themselves for a world where liquidity is scarce, where credit is expensive, and where only the strongest survive. The switch has been flipped. The question now is whether you're ready for what comes next.